Jeni Browne. Welcome to the latest in our Meet the Lender series. And this week I'm really excited because I got the opportunity to catch up with Moises Cruickshank, who is Head of Sales for Keystone Property Finance. Now, a bit about Keystone and a bit about Moises. So Keystone Property Finance are a specialist lender. They've been around for 7 years, doing really great things. So the kinds of deals that they may do, they can lend to individuals, they can lend to limited companies, layered limited companies, they can lend on HMOs, multi-units, they do holiday lets, mortgages for expats and all sorts of really interesting stuff. Their approach is very much that they like to underwrite mortgages based on the strength of the overall case rather than just relying on kind of computer-based decisioning. You're going to see a theme with the lenders we interview here because these are the kinds of lenders that we tend to favour because most people don't actually tick lots of boxes. So really fantastic offering there from Keystone, able to pick up a file, have a look through it and really get under the bones of both the client and what they're looking to do and really kind of try and make a credit risk-based appetite as to whether in the whole the application works for them or not. Now, in terms of Moises, he's a good friend of ours. We've known him for many years. He's been working at Keystone for the whole 7 years. He's a wonderful chap. He really knows his stuff. So I was really delighted that he was able to join me to have a quick chat with me and to introduce himself and Keystone Property Finance to you guys.
Moises, thank you so much for joining me today. It's really lovely to see you. It's been a while. Hope you're keeping well. And so kicking us off with our first question, where you're going to tell us and everybody watching all about Keystone, what would be or who is a typical borrower for Keystone Property Finance?
Yeah, hi, Jeni. Quite typically, we are seeing a lot more limited company directors. So I would certainly say in terms of borrower, they tend to come in the form of limited company directors because, as we know, various different tax changes that have happened over the last 10 years has meant that we are seeing probably about 77% of our business coming in on a limited company basis. And I think that's kind of changed the profile of the applicant that we're seeing. And I certainly think that the majority of them tend to be in SPVs. But increasingly, the typical client that we're seeing is coming to us with various different limited company structures. So people are getting a little bit more savvy with regard to creating leases where they've built block flats and they want to sell those leases down. So they're getting the advice from their accountants to set up subsidiary SPVs. And I think in addition to that, the typical client that we're seeing tends to be a bit more savvy. So we're seeing a lot of portfolio investors. And I think by virtue of where the market has been, a lot of the clients that we are seeing are actively rejigging their portfolios to make them more serviceable. So they might be selling various properties within their portfolios to make things a little bit more fluid for them. And I think also in terms of the type of customer that we're seeing, is we're seeing a lot more diversity in terms of the properties that they're looking to purchase. Landlords are looking for yield. And we're seeing continual customers looking at HMO properties, multi-unit properties, dabbling with semi-commercial properties as well, where they can rent out the commercial unit and then they can create leases on the flats above. And again, the acquisition costs are a lot cheaper for them because, of course, they're not paying the residential rate of stamp duty. So as a result, we are seeing a more complex type of buy-to-let customer, definitely.
What I think you just said in summary is that your borrowers tend to be more often than not a limited company. And with those companies, they can often be more complex in the kinds of transactions they're embarking on. That you are able to lend to portfolio landlords. Any maximum number of properties in the background for Keystone?
Good question. There is no maximum in the background. The only thing that we do ask is that the portfolio covers on 125% at 5.5% on a background stress test. In addition to that, we don't include holiday let properties within our portfolio, or indeed commercial properties, but we can also include unencumbered properties, which just basically helps with the make weight on the mathematics of it.
Thank
In
you.
addition to that, you might even have customers that are carrying on developments. And if those developments are still projects that are ongoing, you don't need to include those either.
They're really generous on the rental calcs, because actually the 125% figure you just gave, if you're using that for personally owned as well as limited company owned.
Yes, to a point. So with regard to how the ICR that we use for a limited company, that'll be 125%. The client is a basic rate taxpayer, will also use 125%. If they're a high rate taxpayer, and this is as per their SA 302, we will work on 145%. So just to give an example, if you've got a landlord who has got a large portfolio in his personal name and he's not looking to move it into a limited company, the big challenge there with some lenders is that they will class them as a high rate taxpayer because all they're doing is they're looking at gross rental income. Now, if they're using a savvy accountant and they're carrying forward losses, perhaps from previous years, their SA 302 may well keep them in as a basic rate taxpayer. We will treat them as such.
Maybe.
A lot of lenders don't. They'll add the gross rent and assume they're going to be a high rate taxpayer.
That's really interesting. And I think actually that kind of really really underpins the kind of basis that as Keystone as a lender, you're not a lender that's driven by algorithm decisions and computer-based decisioning. You are kind of almost quite an old school lender in the way that you pick up a file, you'll look through it and try to make a sort of strong commercial decision based on all of the facts rather than, I hate using this expression, but the computer says no type approach that maybe some of your competitors are using. So that's really good. And I think I've probably stolen them, but our next question for you, Moises, is what would you say are Keystone's top 3 USPs?
I think our top 3 USPs are the fact that we can look at limited company corporate structures and adopt a flexible approach to
What does
them.
that actually mean for people who maybe don't understand that in more layman's terms?
Okay, so as you know, if you've got a client who goes out and builds a block of 10 flats, their main objective is to exit some sort of development finance. The problem that they've got is that if they try to remortgage in the name of that development limited company, we know that development companies usually are treated as trading limited companies, and many lenders say that you've got to have 2 years profitable trading, but of course we know development companies generally don't. So what clients usually do is they get advice from their accountant, and what they can then do is they can consider breaking up that multi-unit into individual leasehold flats. So they go through a process of creating and selling that lease down into a subsidiary SPV. And the benefit of using a subsidiary is that when they create the leases, ordinarily you'd have to pay an SDLT, but you can utilise group relief. So thereby you can effectively not pay that stamp duty liability, unless of course I believe if you dispose of that property within a 3-year period. So as a result, we're seeing a lot of complex structures where you've got a holding company followed by a subsidiary. And that will throw a lot of brokers that don't often work in that space. And it's something that, you know, at Keystone, we pride ourselves on being able to offer that type of criteria.
Good. That's number 1.
Number 2 is with regard to unusual property types. We are very flexible. So we can lend on multi-units and HMOs up to 15 bedrooms or 15 units within the block. But in addition to that, we will look at hybrid properties. So where you've got a multi-unit freehold block that is being partially used as an HMO, or you've got an HMO that has individual kitchenettes and shower facilities within each of the bedrooms, because many of our competitors don't allow that. We also look at flats above commercial. So again, you know, where I've mentioned that a lot of landlords are looking to diversify, many lenders aren't able to lend on flats above restaurants, takeaways, minicab offices, licensed premises. We in fact can. So again, we're offering a lot of variety in terms of the property types that we can lend on. And then finally, within that USP of looking at unusual properties. We can lend on ex-local authority flats, even with deck access.
Okay, perfect. And Moises, I'm just going to circle back a little bit to the point you're making about HMOs and multi-unit freehold blocks where you can do a kind of blend of the two. So with your, what loan to value can you go up to on HMOs and multi-units? Is it 80?
Yeah, we can go up to 75%.
75, yeah, brilliant. And the other question I think people might be interested in when they're watching this video is when you're talking about those, particularly those larger buildings, investment valuations rather than bricks and mortar.
Yeah, that's an interesting topic, Jenny, because we do send out our valuers and we panel out to Method. And the reason why we panel out to Method is that they use valuers that are in tune with valuing these exact type of properties. So as a result, we will instruct the valuer to give us an investment valuation if the property deems it applicable. So a lot of the tests that the valuers do is they say, right, okay, if it's an HMO, does the property benefit from C4 planning or sui generis? So for example, if you've got an HMO in an Article 4 area and the property's got C4 planning, well, that makes that property more attractive to an investor. So as a result, a value is more likely to give an investment valuation because there's an investment value attached to that property. In addition to that, with HMOs, sometimes they are so heavily adapted that it would be very difficult to turn that property back into a standard residential. And I think there is the acid test. If you've got a house next door to you, Jenny, if you decide to buy it and let it out to 3 bedrooms and you're letting it out to 3 professionals, but you've done no work to the property, tomorrow, if another buyer came along, that property would sell as a residential property. Whereas if you've got an HMO that's been so heavily adapted that it would cost a lot of money to convert that back into residential, then there's additional bonus points there, I think, from a valuer's perspective in terms of him giving an investment valuation.
That's amazing. And yet I'm sure at Keystone, you can't say yes to absolutely everything. So what was kind of like the main reason that you're seeing for declines at the moment?
Yeah, declines, that's always an interesting one because cases decline for a variety of reasons. And I think, first of all, the case not fitting criteria. So for that point, I'd always urge brokers to please do call into the internal sales team or local BDM just to talk about the intricacies of the case to make sure that there's going to be nothing that slips us up. Secondly is adverse credit. So when we run a credit search, we run the credit search against the individual. However, sometimes we find landlords have got multiple companies and they might have either mortgage arrears or CCJs. Now, we don't have the option or the ability to be able to back search those companies on AIP. So I would always urge brokers to effectively carry out a credit safe check just to make sure that there's no adverse credit on associated companies that they might have directorships in.
So what you're saying there is that you do the AIP, there's no scope to credit search all of their background companies, which no lender can do instead. This isn't just a problem with Keystone. But actually what you're then finding is that when you guys pick up the file and start underwriting it, things come up later that when you're doing your more in-depth kind of review of the borrower, and that's when sometimes it could be an issue.
Absolutely. Yep. So I think the key tip is, do look at background companies that your applicant is involved in.
Yeah. And if, say, for example, you did find some adverse credit on a borrower, like I believe that you're a lender who, again, tries to lend. So are there kind of like hard lines, we can accept this, but anything beyond that point is a no for us? Where do your sort of parameters sit?
Absolutely, Jenny. There are parameters within lending criteria that allow for things like defaults, late payments on a mortgage, etc., etc. There have been occasions where, someone's picked up a CCJ for, let's say, £257 for a parking ticket. They run a fleet of vans, and maybe one of the drivers decided to pick up a parking ticket which was never paid. Now, in the great scheme of things, it depends when it was incurred. there is potentially some sort of scope to look at these types of cases, but these are cases that have been in flight, not cases that we will take through the door initially. So I think we kind of look and see what exactly it is. There are some immovables, but then there are parts of lending criteria that we can certainly look to make an exception on if appropriate, and if we feel that the risk profile of the applicant suits the exception.
Yeah, perfect, thank you. Now, in terms of your experience of mortgage applications coming to Keystone and kind of getting things through in a fairly seamless fashion, how can applicants really kind of try and ensure a smooth and quick application process with Keystone?
Okay, I think one of the first things is getting the paperwork correct. So, for example, most lenders will ask for SA 302s and tax zero reviews. So it's a case of making sure that all the figures match on the tax documents, because sometimes it depends on the accountant. Have they had a bookkeeper prepare the accounts, or have they indeed done it themselves? So just making sure that they get things correct with regard to a lot of taxation documents. That'd be one of the first points. Another point in terms of what brokers should do is if we ask to see evidence of mortgage payments for a particular mortgage account, i.e. a buy-to-let in the background, it's always a good idea to maybe highlight the payments on the bank statements and just write 55 a case here. It helps the underwriters, because when they get a whole ream of bank statements, they know exactly what they're looking for. And I think helping the underwriter just helps us to move that case on a lot quicker, because the underwriter can just scroll through all the pages and say, yep, I can see the last 6 months payments, they've been highlighted, and I can see that they relate to the mortgage account. So I think that's always helpful in terms of making sure that you can help the underwriter to help you move the case on a lot quicker.
In terms of that, and that raises a really interesting point that people probably wouldn't necessarily know. So as a lender, you do a credit search on a borrower and you would expect all of their mortgages to appear on the credit file. So you can see account conduct there, and yet you just referenced evidencing mortgage payments. So is there a scenario where sometimes those mortgages don't appear on the credit file and therefore you can't see the account conduct?
Yeah, absolutely, Jeni. So typically, a borrower may have a residential mortgage, and that'll show up on their personal credit score. But if you've got buy-to-let mortgages and limited company names, when we carry out credit score, we're credit scoring the individual, not background companies. So as a result, we don't know what the mortgage conduct looks like until you get to the underwriting process. So it's certainly a case of, asking the landlord, have you been up to date with your mortgage payments on other buy-to-lets? And it could be buy-to-lets that they've got with other business partners.
Yeah.
So again, asking the brokers to make sure that they're checking through, asking the right questions. Because if you say to a customer, oh, have you had any late payments on a mortgage? They usually default to thinking about their residential mortgage, not thinking about the buy-to-lets that they've got in the background.
Yeah, fair. Okay, cool. Right, we're now going to move on to everyone's favourite subject, which is the Renters' Rights Bill. So at Keystone, how do you think, if any impact at all, the upcoming changes in legislation are going to impact how you guys choose to lend?
I don't think that'll be a departure in terms of any criteria that we have to change. I think it's got a wider implication in terms of the types of borrowers that will start to think, is buy-to-let something that's worthwhile as an investment? Because I think a lot of the larger landlords, what will happen is they will gear up their systems to cope with it and to cope with all the intricacies of actually making sure that they're when they're serving notices correctly, etc., that the properties are getting registered on the registration portal. A lot of smaller landlords will probably think, do you know what, this is too much effort.
Too hard bucket, yeah.
There's too much involved in possibly just running, 2 or 3 buy-to-lets. it may put some people off, but again, I think there'll be opportunity for others. And there'll be opportunities, I think, for larger landlords that have got the ability to kind of manage this on a macro basis, as opposed to someone who's doing a full-time day-to-day job. All of a sudden, all these requirements have been thrust on them. So I think, that will have an implication. I also think that it will make landlords consider other types of tenancies. And we don't lend on these, but we are seeing that a lot of the Serco housing association tenancies have become very popular.
Why don't you lend on those?
Various reasons. I think there is a lot to be played out. You've got reputational risk, for example, with those types of tenancies, and that's purely by virtue of the type of tenants that reside on those properties. And of course, we know that it's become a political hot potato as of late with regard to asylum seekers. So at the moment, I would say we won't be lending on those at the moment. I think that's a decision that has been made and is reflected in our current lending criteria. But I think that a lot of landlords will consider those types of tenancies because, look, they're locking it away for 5 years. They're getting a guaranteed rent, and they haven't got to comply with the onerous situations that they're going to be forced to kind of have to uncover. So it's just a case of you buy a property, you renovate it, you dish it out to the housing association as an example on a 5-year tenancy, guaranteed rental income. You haven't got tomorrow. So I think we'll see more landlords kind of looking to go that way if that's their business model. So it's an interesting one, whether it pushes more people towards that type of tenancy. We will see, but of course we've seen other lenders prepared to lend on that basis. So there is currently a market for that type of landlord, definitely.
Yeah. Okay. But as it stands at the moment, Keystone aren't kind of looking at the Renters' Rights Bill and thinking because of, I don't know, the abolishment of Section 21, we're going to do this differently or look for this in addition to, the information we would. You're not making those kinds of changes. It's business as usual for you guys.
Yeah, absolutely. But of course, we've got to also be conscious that there's going to be a major shift for landlords. So I think it's important for us as lenders to ask brokers to make sure that their clients are aware of the changes, because you know what it's like. These changes will suddenly come around, and of course you can't play ignorance to it. So I think the broker's role is now a lot more enhanced in terms of not only advising on the mortgage, but also advising their customers on the potential change and what's going to be possibly seismic change for landlords. You've got other things such as taxation, where HMRC landlords that own properties in personal name are going to have to do their tax returns a lot more frequently. So we've got
I'm one of those, yeah.
You're one of those, Jeni. So, again, an example of another challenge in the marketplace that, yourselves as brokers will have to be talking to your clients about.
There's never a time where there's something not to talk about, is there? Just keeps going. Last question for you, Moises. Thank you for giving up your time today. Where do you see the future of the PRS?
Well, I think despite various different governments making it a lot harder for people to invest in buy-to-let property, I think it will continue to remain healthy. I think we'll see bigger landlords become even bigger, but you will see less smaller landlords, because I think, they'll pull out of the market. They may sell the property, but then any bargains or any properties with great yields will be simply bought up by either larger landlords or increasingly corporate landlords. Because, we've seen some corporate banks, I think Lloyds Bank, Legal & General, they're looking to increase the amount of properties that they own, and that'll be part of their own strategic plans with regard to a diverse portfolio. I think also the buy-to-let market, as you'll know, there are securitisations that happen on a regular basis, and we did ours, I think, back in June, which effectively sent out a good signal to the market that buy-to-let is still a very popular investment for the fund managers, various different banks and institutions that still see buy-to-let as a good part of their investment acquisition portfolio.
Yeah.
So from that perspective, every time we hear about someone like ourselves, it could be Keystone, it could be Quantum Mortgages, successfully completing a securitisation in the market, that is a good sign for all of us, because it just means that we can see that the buy-to-let lending market is healthy.
Yeah, and that's really important. If the buy-to-let market goes awry, then we've seen this before, haven't we, with the credit crisis and various things over the years. So yeah, we do need that to certainly be the case. Moises, thank you so much for talking to me today. It's been really interesting. And I look forward to catching up with you soon.
Thanks, Jeni. Been a pleasure.
Bye.
And there you have it. That was Keystone Property Finance. Thank you again to Moises for your time. I do hope you all found that useful and interesting. If there is any lenders that you would particularly like us to get in and try and have an interview with and do the same questions, let me know. I'd be very happy to do that, to take requests. Likewise, if there are any questions that you think would be really interesting for us to be asking these lenders, do let us know as well. You can just leave a note in the comments. That's absolutely fine. Thank you so much for watching, and we'll see you with the next episode soon.